Get ready, gold bugs. This week is packed with economic data that could move the gold market. From consumer confidence to jobs numbers, we've got a lot to unpack. These reports will give us clues about the economy's strength and the Federal Reserve's next move. As always, remember that gold loves uncertainty, and this week might deliver plenty of it. Why does this matter for gold? Well, when the economy looks shaky, investors often turn to gold as a safe haven. On the other hand, if the economy seems strong, the Federal Reserve might raise interest rates. Higher interest rates can make gold less attractive, as it doesn't pay interest like bonds do. So, buckle up, and let's dive into the data. Tuesday kicks off with the Conference Board's Consumer Confidence Index. If consumers feel good about the economy, they tend to spend more. This spending can lead to economic growth, which might push gold prices lower. Conversely, weak consumer confidence could signal a slowdown and potentially boost gold. Later on Tuesday, we get the JOLTS report, which shows us job openings. A high number of job openings usually indicates a strong labor market. This strength could lead to higher interest rates and potentially pressure gold. However, if job openings disappoint, it could raise concerns about the economy and support gold prices. Wednesday brings the ADP Non-Farm Employment Change Report, a sneak peek at private sector job growth. A strong ADP number often precedes a strong non-farm payrolls report on Friday. Good news for the economy can be bad news for gold, as it might lead to higher interest rates. A weak ADP report, however, could signal economic weakness and boost gold. We also get the first reading of third-quarter GDP on Wednesday. This report tells us how much the economy grew in the previous quarter. Strong GDP growth suggests a healthy economy, which might lead to higher interest rates and pressure gold. Weak GDP, on the other hand, could raise concerns about a recession and support gold prices. Thursday is all about inflation and spending. The core PCE price index is the Federal Reserve's preferred inflation gauge. If inflation remains stubbornly high, the Fed might raise interest rates again, potentially hurting gold. However, if inflation cools down, it could give the Fed room to pause rate hikes, which might be good for gold. We'll also get a look at the Employment Cost Index, which measures how much businesses are paying for labor. Rising wages can contribute to inflation, so a hot ECI report could lead to higher interest rates and pressure gold. A cooler ECI report might suggest easing inflation, potentially supporting gold. Finally, Thursday also brings us initial jobless claims. This report tells us how many people filed for unemployment benefits for the first time. A rising number of claims could signal a weakening labor market, potentially boosting gold. Falling claims, however, suggest a strong labor market, which might lead to higher interest rates and weigh on gold. Friday is the grand finale with the release of the Non-Farm Payrolls report. This report tells us how many jobs were added or lost in the economy. A strong jobs report usually leads to higher interest rate expectations and potentially lower gold prices. A weak report, however, could signal trouble in the economy and support gold. We'll also get average hourly earnings on Friday, which tells us how much workers' wages are increasing. Like the ECI, strong wage growth can contribute to inflation. This growth might lead to higher interest rates and pressure gold. Weaker wage growth, however, could suggest easing inflation, potentially supporting gold. Last but not least, we have the ISM Manufacturing PMI. This index measures the health of the manufacturing sector. A strong PMI reading suggests a healthy economy, which might lead to higher interest rates and pressure gold. A weak PMI, however, could signal a slowdown in manufacturing and potentially support gold prices. This week is a minefield of economic data, and it's important to remember that gold's reaction can be unpredictable. Strong economic data might not always hurt gold, and weak data might not always help it. Other factors, like geopolitical tensions and currency movements, can also influence gold prices. The key is to focus on the bigger picture. Is the Federal Reserve likely to keep raising interest rates? Or are we nearing the end of the hiking cycle? Is the economy headed for a soft landing, or are we headed for a recession? The answers to these questions will ultimately determine the direction of gold prices. So, stay informed, be prepared for volatility, and may your portfolio shine bright.